Hello, this is Ahura from Alted Markets. We'll be with you to check the US inflation data and also initial jobless claims and market reactions. Let's first check the data as always and see what we have first in the calendar, and then we can see how market can react to these data. As you can see in the screen, the U.S. inflation and core inflation both in the monthly scale and monthly basis increased slightly more than expected, but at the same pace as we had in August. Inflation CPI increased by 0.2% and core CPI increased by 0.3%, as you can see here. Both of them, they repeated the same piece of the previous month, but slightly higher than expected. But on the annual scale, core CPI increased from 3.2% to 3.3%, meeting the estimates of 3.2%, while the market was expecting to repeat the same piece of previous month. But core CPI increased slightly more than expected. The main reason for that can be the slightly lower price of the oil and generally the energy in the last month. But however, it's increased this month, which can change the outlook for the next month. On a headline front, CPI slightly eased to 2.4% from 2.5% printed in August, but slightly higher than 2.3% market expectations. That number can tell us that U.S. economy we have more challenges to slower down, to cooling down the inflation, and it will be more challenging way to see the lower levels. That means that the Federal Reserve can change slightly. We can change actually, and the Federal Reserve also can change slightly its policy. Maybe maybe the thing that maybe they changed that the mind of the needed for faster rate cut, and we will talk about that. We'll check the inflation and the labor market data also first, and I will come back to the Fed outlook. On the labor market, initial jobless claims increased from 225,000 application, which we had the previous week, to 258,000 applications. That number in this week and the next week for the next 2 or 3 weeks also can slightly still increase, as we had the storm in Florida and other states in the United States that can cause more jobless at the short term. So that's why the initial jobless claims this week, next week, and the week after that, in this week and next 2 weeks, would not be so much as a resource, and we can say that, okay, we can tell that the labor market is weak, because it's not because of the labor market or production or economy. It's because of something out of the economy. So that's why we cannot count that as the weakness in the labor market. Anyway, the labor markets we had more claims for initial jobless, for more claims for unemployment benefits. In the continuing jobless claims also increased from 1,890,000 to 1,861,000. I have to mention that, yeah, these numbers are not all, this weakness is not 100% because of the storm, but still that can be very important point for that, and we can say that, okay, it plays a very important role. Let's go before going to see the chart. I have to mention, look, we here now as the inflation increases, yes, okay, slightly, which means that the Federal Reserve still need to hold the rates higher for longer and no more 50 basis point rate cut. But at the same time, we had a weaker than expected jobless claims, more claims actually for unemployment benefits, which that caused that, okay, the economy is still facing, the labor market is getting cooler, so we need more support. So that's why the 25 basis point rate cut is more under, I mean, it's more demanded, it's more needed right now. So that caused to see that the lower expectations for not changing their rates and holding the rates at the current level from 17%, which we had earlier today before data published, to 15%, while the 25 basis point rate cut increased to 85% almost. Expectations for 25 basis point rate cut. So that means more dovish expectations from the Federal Reserve in its next meeting. Let's go and see the chart, how the chart reacted to, how the markets reacted to this data. We can start with the US dollar index. The US dollar index, okay, let's go here. The US dollar index somehow in initial reactions, it's like it's still thinking, the market's still trying to analyze the data and expectations. Yeah, the weaker data in the labor market in a first look means that, yeah, we have to be more dovish expectation from the Federal Reserve. But as I told, these data means that this data is basically because of the storm that we had in the United States. It's not because of the economy. So market cannot understand that slightly by the time passing. So this initial reaction can be reversed. These data generally means that the inflation is still high and will be higher for longer. That's why holding the rates at the current level still can be an option in November meeting, or even not. A 25 basis point rate cut is much more is much more hawkish expectations compared with 50 basis point rate cut expectations that market was counting on that week ago. So that's why the US dollar index still can hold its positive trend, and it can hold this uptrend, but slightly uptrend. The 103.50 is the maximum level that we can expect for the US dollar index in a short term, but slightly, as I told, market will have a challenging numbers here, but generally the US dollar can still be in demand. If you're looking at the gold markets, the gold will with the stronger US dollar, gold can get on slightly pressure, but still, as we will go to the stock markets, as the stock markets gets a slightly negative impact from this, that gold can still hold its demand. On the other hand, also the gold already had this correction and touched 2,600 level earlier today, almost 2,601 earlier today. So we can say that the most probably the gold correction here is ended, and gold can start slightly uptrend again from these levels. As we check the stock markets, S&P 500, as you say, it had a negative reaction at the beginning, and we have a negative reaction of S&P 500 here. But these data, these data, while the inflation was harder than expected, labor market was weaker. So negative impact on the stock markets expected, but not we cannot say that negative impact can be very fast or very harsh negative impact. So generally, but this data can have the negative impact on the stock market and can cause more correction for now. Yeah, that's the data and the market reactions. The same reaction we can see for Dow Jones, for Nasdaq as well. They are the same. We have the same reactions here in these markets. If you had any other question, don't hesitate to write in the comments. I will try to get back to you as soon as I can. Have a good time. Bye-bye.